When I started my first job in October 2023, I had 20,000 Swiss francs ready to invest. I had the account, I had the money, and I had the plan. And then I waited 6 months. By the time I finally invested in March 2024, the All Country World Index had already returned roughly 20% from where I could have bought it in October. On 20,000 Swiss francs, that's somewhere between 4,000 and 5,000 I didn't make from doing nothing. In this video, I will show you what I learned from that mistake and what the data actually says about whether you should invest now or wait. The answer will probably surprise you, and at the end I will give you the exact 3-step framework I now use so I never make this mistake again. So here's exactly what 6 months of watching the market actually looked like. October 2023, the market had just dipped a little bit, a perfect entry point in hindsight. I didn't know that at the time. I thought it might drop further, so I waited. November, the market started recovering. I was still watching and still not convinced. December, up again. January, up again. I kept telling myself I'd invest when things settled down. And they never settled down. February, I started reading about lump sum versus dollar cost averaging. Maybe I should spread the 20,000 over 6 months to reduce risk. I built a spreadsheet comparing the two strategies. March 2024, I finally invested. The All Country World Index had already recovered almost entirely from the October dip. I bought in at prices roughly 20% higher than I could have. Every reason I gave myself made sense at that time. I was being careful. I was doing research, I was building a spreadsheet, but looking back, it was all just the same thing. The market going up and me on the sidelines watching. And here's what stung the most. The data shows this isn't just my experience. Almost everyone who waits loses money doing it. And I will show you the research in a moment. So every investor who waits is waiting for the same thing, a better entry point. The logic makes sense on paper. Markets go up and down. If I wait for a dip, I buy cheaper. And buying cheaper should mean better returns. But here is the problem. Nobody knows when the dip is coming. And while you're waiting, the market has strong upward bias. So global equity markets have posted positive returns in roughly 73% of calendar years since 1928. Which means while you wait for a dip, you're statistically more likely to be watching the market go up. So every day out of the market is a day of compounding running without you. And the brain also does something specific under uncertainty. It mistakes inaction for safety. So the cash feels safe because the number doesn't go down. But it's losing ground to inflation every month and missing the returns the market is generating. Waiting doesn't feel like a decision, and that's exactly what makes it expensive. In 2012, Vanguard published a research paper comparing lump sum investing against the dollar cost averaging across the US, UK, and Australia, using historical data going back to 1926. The finding was that the lump sum investing outperformed the dollar cost averaging approximately 2/3 of the time, with an average outperformance of around 2.3%. 2/3 in most historical scenarios. Investing everything immediately produced better results than spreading it out. The math behind it is simple. Markets trend upward over time. Every month you delay, you're statistically more likely to be buying at higher prices than lower ones. But the part that matters the most, and the part that the Vanguard paper emphasizes, is this. Both strategies, so the lump sum and the dollar cost averaging, dramatically outperformed staying in cash. So the gap between investing immediately and investing gradually was relatively small. And the gap between either and doing nothing was enormous. So if this makes sense to you, hit the like button. It genuinely helps more people find this. So what's the actual answer? Invest now or wait? Almost always now. But there is one legitimate exception. I will cover it next. And it might apply to you. So the one reason to wait before investing a lump sum is if investing it all at once could cause you to panic sell the moment the market drops 20%. So the Vanguard data assumes you hold through volatility. If you invest 20,000 as a lump sum and then sell when it drops to 16,000 3 months later, you have destroyed the entire mathematical advantage. Dollar cost averaging, so spreading the investments over time, can help investors with lower risk tolerance stay in the market through drops. because they haven't committed everything at once. So the real question is actually not lump sum investing or dollar cost averaging. The question you should ask yourself is, can I hold through a 30% drawdown without selling? If yes, invest now. The math strongly supports it. But if the honest answer is no, spread it over 3 to 6 months. You will likely make slightly less, but you will actually stay invested, which matters far more than the entry point. So what you should never do is what I did. Wait indefinitely, with no plan and no timeline. That's the most expensive option every time. So here's what I do now when I have cash ready to invest. Step 1. Set a deadline. 1 week, and on day 7 I invest. No extensions and no 1 more week to think about it. Step 2. 1 question. Can I hold this through a 30% drop without selling? If yes, I invest everything on day 7 as a lump sum. If no, I set up a 3-month dollar cost averaging schedule and start immediately, not later, immediately. And step 3, no market checking during the decision week. Watching prices during the decision period is not research. Every day I watch without acting is a day of potential return I'm leaving behind. If I had followed this in October 2023, I would have invested by October 7th. I would have captured the full recovery. I would be approximately 4,000 to 5,000 francs better off today. So the answer to invest now or wait is almost always now. The data says it. My own experience confirms it, and the only exception is if you genuinely can't hold through volatility. And even then, the answer is dollar cost average immediately, not wait indefinitely. So if you want to follow what I'm actually doing with my portfolio going forward, subscribe. 1 week a video, real Swiss numbers. I'll see you in the next one.